Hello, my name is Tony. I will introduce you probably the most profitable stock portfolio allocation with least possible risk for next 10 years. For the last 3 years I have been doing research and analysis to create very long-term investment portfolio. My investment return is 180% and I can prove it by my interactive broker's portfolio report. By my investment return, I paid Harvard Business School tuition. My market forecasts have been right many times. I put all my education, experience, knowledge and love to create this portfolio. I hope this will help you to increase your wealth. After taking this course, you will not need a hedge fund analyst or financial advisor for the rest of your life. Let me introduce my background. I graduated Oakland High School in Virginia in 2010 and I graduated State University, studied financial management in 2013 and I took some courses at Online Trading Academy in Virginia, and in 2022 I graduated Harvard Business School. I studied accounting and data science. My first professional work experience was working as a financial analyst at SF Business Solutions, and I moved to Columbia Bank. I worked as credit analyst, segment analyst and foreign segment manager. And then I moved to Columbia Capital brokerage firm. I worked as domestic stockbroker, international stockbroker and international stock dealer. And then I moved to Columbia Asset Management Hedge Fund. I worked as a portfolio manager. And then I moved to Namin Insurance Company. I worked as Director of Corporate Insurance Department. And currently I'm in the process of founding my own financial advisory firm. I named my firm as Mirat Imperium. And my investment performance would be 180%, which is realized gain, and I forecasted 2021 market downturn and sold all my stock and ETF positions in September of 2021. I published books. The names would be Future Investment 2022 to 2033 and Financial Crisis of 2008 and 2009. This course is intended to everyone, regardless of occupation, and whoever wants to increase his or her money by investing in US and international stock markets. You can be a chef, pilot, actor, nurse, doctor, teacher, lawyer, engineer, scientist, pharmacist, programmer. You'll be able to understand, you'll be able to create very diversified, very good portfolio. Be the master of your hard-earned money by yourself. Don't invest in hedge fund or a mutual fund. They usually take away 2% of your initial investment amount and 20 to 30% of your investment gain every year. You can invest better than the hedge funds by following my long-term investment advice. I'm a hedge fund insider. I know what they do. You can do what hedge funds do by yourself, not taking huge risks. I can help you to save and increase your money and fully take advantage of your stock investment return for the rest of your life. I cannot promise you that I can make you a billionaire, but I can promise you I can bring financial security for you and for your family's future. Last year I attended CNBC's Financial Advisor Summit, and after the summit I was in special session room with CNBC's TV senior Wall Street correspondent Bob Sunny and hedge fund analysts. We talked about many issues regarding investment in all around the globe, and I'm going to be talking and discussing about the topics, issues we have discussed in this advisor summit. Diversification with concentration. For me, well-diversified portfolio is same as huge ship, which has higher chance of surviving many storms and reach its destination. Concentrated portfolio is same as small boat, which has small chance of surviving any storm. Like market crashes of 1929, 1987, 97, 2000, 2007, 2020, 2022, crashes will always occur across the continents and countries and sectors. Therefore, it's necessary to spread the risk and create well-diversified investment portfolio. Financial markets will be turbulent forever like this ocean. Millions of investors have lost billions of dollars and sunk into the ocean. You can avoid being one of those who sank by following my good investment wisdom. Life is a long journey, but sometimes even small financial risk can ruin your whole life. So, which financial boat do you want on board? I have come up with a huge financial boat to make your financial future secure. Invest with peace of mind and enjoy your life with your investment gains. Last few years I've been studying and researching whether there is a bubble, tech bubble especially in US market. As you can see from this slide, the greens are small cap value ETFs, the other blue lines are US stock indexes, Nasdaq, S&P and Dow. When tech bubble bursts, tech stocks fall sharply, small cap value ETFs tend to increase. So I'm going to discuss in detail what I have found between tech stocks and small cap value ETFs. I will discuss the relationship between these two different kinds of stocks. This is very intriguing. Correlation analysis between GDP and stock index. Last few years I've been looking for opportunities around the globe, and I run correlation analysis on many countries, and I'm gonna introduce first 11 countries results to you guys. As we can see from this analysis result, the correlation between GDP and stock index is minus 0.25, which means there is no correlation between X variable GDP and Y variable stock index. Thus, we cannot allocate more money to countries whose GDPs are likely to increase more than the others. We better allocate evenly between countries regardless of how much GDP is forecasted to increase next year. Japan and South Korea are not chosen as a good investment because the research and analysis results showed the probability of good return is small. I took a look at many countries' FDI stock investment. There is inward and outward FDI stock investment. The inward FDI stock is the value of foreign investors' equity in and net loans to enterprises resident in the reporting economy. The outward FDI stock is the value of resident investors' equity in and net loans to enterprises in foreign economies. FDI stocks are measured in USD. As you can see from this chart, this is FDI stock investing for Japan, inward with outward. The green line represents the inward, the red line represents outward investment. Since 2005, Japanese inward investment didn't really increase that much. In 2005 it was 100 billion, and now in 2022 it's 237 billion. Only 2.5 times increase. But when you take a look at outward investment, in 2005 it was 386 billion. In 2022 it is 1.8 188 trillion, which means Japanese investors, Japanese business people are not really optimistic about their own country. They are investing overseas for more than last 10 years, which is red flag because think about it in terms of Japanese businessmen. Put yourself, in Japanese businessman's shoe, and you have $10 million, then you are investing all your money in other country than your born nation, which means you know that your country's economic, financial performance are not gonna be good next year or in year after that. So this sign is one of the red flags investors should be aware of. And I developed IQI ratio or inward-outward investment ratio to precisely figure out what's going on to certain countries' investment money flow. Inward money amount is divided by outward money amount. If IQI ratio is better than 1, then the country is getting more money than outgoing money, which is good for all companies. If IQI ratio is lower than 1, which means country is losing money, meaning more money is going out than coming into the country, which is bad for all company and GDP. This is IQI ratio for Japan. As you can see, since 2008, the IQI ratio was 0.3. Now it's 0.13. The ratio has been falling since 2008, meaning more money was going out than more money was coming in to Japan. 0.13 means Japan has received equal to 13% of outward amount of 1.88 trillion. Inward 237 billion is divided by outward 1.88 trillion equals 0.13. So as an investor, you should be aware of this IQI ratio. Since the domestic investors are pessimistic about their own country's economy next year and year after that, you better not be investing in that country. To attract investment, let's compare it to a company. If you are a company manager, you're a CEO, and you are trying to get a loan from a bank or trying to raise money on public exchange, you gotta be optimistic about your own country's own company's future, right? But when you're pessimistic about your own company's future, then the bank will not give you money, and the investors will not give you money, right? It's the same thing. When certain countries' businessmen are investing their money outside, then it should be red flag. And after long research, and I have come up with 20 ETFs to invest. So I will discuss these ETFs and why I have chosen these ETFs to invest, why I have chosen these countries as an investment. So I'm gonna talk this in detail in my course. In my course, I'm gonna discuss what's the next investing hub would be in Asia for next 10 years. For the last 20 years, China, South Korea, Japan, Taiwan, Hong Kong was the hub, investment hub in Asia. But the landscape is changing, the continent is changing, due to war risks of Northeast Asia. Investors are likely to avoid Chinese and Taiwanese, South Korean, Japanese markets. So where's the next investment opportunities in Asia? There is high probability that Malaysia, Singapore, and Indonesia will become the next investment hub. The main advantages of these countries are very low risk of war, sea trade routines from all other continents, large educated population, Singapore 5.5, Malaysia 32 million, Indonesia 276 million. Natural resources. Malaysia and Indonesia have rich natural resources when compared to Taiwan, South Korea, and Japan. So I'm going to discuss in detail why these countries might be a next investment hub in Asia. To choose my investments, I run factor regression analysis on chosen investments. I'm going to discuss what were the results and why such investments, ETFs, and countries were chosen. I'm going to discuss the 23 chosen ETFs, data analysis, Sharpe ratio, Sartino ratio, and market correlations in detail. And the risk composition. Which countries' risks are greater than the other countries? I'm gonna show you the comparison. I'm gonna choose why these were chosen. I'm gonna tell you why some countries were not chosen. And I'm gonna discuss in detail each ETF's data and information. As you can see from this slide, this ETF's ticker is TQQQ, ProShares Ultra. Since inception in 2010, price increased 4,714%. And TQQ price has declined 74% from its all-time high price of 88.72 22.9, which means 74% bargain for you. And you can see from sector allocation, TQQ is mainly consists from tech stocks, and next consumer service, consumer goods. And you can see from this section, these are the top holdings of the TQQ: Microsoft, Apple, and Amazon, PepsiCo, and this will go on. And you will see each and individual ETF's holdings, data, and performance. So the end result is here. All research, analysis, data, pros and cons, thinking created this portfolio. 3 continents, 9 countries, 23 ETFs, 2,922 companies. This portfolio risk is beta is 0.95 when compared to Nasdaq index, which means risk is lower than 3,600 stocks of Nasdaq index. Beta 0.95 was calculated by Nasdaq portfolio screener. My course consisted of total 120 PowerPoint slides. There are a lot I will tell you and teach you. Welcome aboard on my investment ship. Let's take this journey together around the globe and help you secure your financial future.